Set it and forget it.
Set it and forget it.
You just set it and forget it.
You just set it and you forget about it.
You just set it and then forget it.
You just set it and forget it.
Set it and forget about it.
You set it and forget it.
And that, to me, you can almost think of that as one of the coolest jingles out in the. You can almost think of that as.
You just set it.
Set it and.
Ron Popeil is a master at creating products for TV, but he had his rotisserie oven, and he said, "Set it and forget it."
Set it and forget it.
Set it and forget it.
You just set it and forget it.
You just set it and you forget about it.
You just set it and then forget it.
You just set it and forget it.
Set it and forget about it.
You set it and forget it.
And that, to me, you can almost think of that as one of the coolest jingles out in the business. And
yeah, and it's also what a lot of people need to do in the VIX right now. Welcome to Short Vol Show Live. My name is David Lincoln, and it's time for us to set it and forget it. Welcome to all you out there. You know, I've taken a lot of criticism, and I've decided I am going to once again hide my P&L. I've been putting my the size of, I have this sample account, and I've been putting up the P&L. My thought behind it was, you know, I'll be transparent, and I'll show people when I make money and when I lose it, because I want to distinguish myself from those, you know, those people online who, you know, they want to charge you $2,000 a person to go to Hawaii for a week, trade for 10 minutes, and then go out on jet skis and hang out and pump iron with a bunch of sweaty guys and convince you that they get 200% returns per day. Now, if you were able to get 200% returns per day, you would very quickly have so much money that you wouldn't need to hang out with a bunch of sweaty guys on Hawaii to collect $1,000 from them. So the point of, but the problem is that putting up my P&L has resulted in people, you know, questioning me. They're like, you know, if I put up a P&L that's like, or an account that's like $5,000, then people are like, oh, well, this guy has no credibility because he's only trading with $5,000 or $10,000. However, if I were to put up an account that had $100,000 in it, then I have real fears of someone like doxing me and like some drug dealers that I used to associate with in Hyannis coming and trying to roll me in my apartment for my money or something like that, or some ex-girlfriend seeing that I have money and coming after me or something. So I don't feel like it's a good idea for me to publicly show a bunch of assets. So, and for other reasons which you can imagine. Anyway, let's get onto the VIX here for a second. And yeah, I made a call that we were going to, that it was the top like a week ago, which was completely didn't work out. And surprise, surprise, I'm wrong at times as a trader, and that is another good lesson to learn, that traders are often wrong about things. And it kind of goes contrary to like the social media thing where everyone's trying to prove they were so smart on StockTwits and that they predicted it. And as I've said many times before, I don't think it's a wise decision to be following what someone else does online and then just follow what they do just because you like them or something like that. Or even if they were able to show that they're profitable in the past, just following someone else's strategies is not the way to make it. The way to make it is to develop your own strategies. All right, now I want to talk about, I ran that set it and forget it clip at the beginning of the video because to make a very specific point, and that is we are high historically in the VIX right now. So a very easy trade to put on is shorting, picking some options far out in time, and by far out in time I mean more than 3 months before expiration, and just putting that trade on, and then just don't look at it, just leave it, don't look at it for a while, let it ride. But to look at a more basic, some basic concepts about what we need to look at right now as far as making progress to the downside in the VIX. It's not actually looking at the prices of VXX and UVXY right now because we have a very specific problem on our hands, and that is we are still very inverted in the term structure. The VIX is the VIX cash or the actual VIX number is at a higher price than all the futures right now. This is called being inverted. So let's pull up a chart of VIX Central just to show you that visually. Let me get out of the way here for a second. So you can see here the spot price is higher than all of the other prices on this chart. And let me actually, why am I not out of the way? Oh, there we go. And so this stuff is not going to start acting more quote unquote normally until this cash, this VIX cash, is lower than all the futures. So progress, remember this, progress day to day is reducing the difference between this spot price and the futures. Now, if we go back last week to Friday, which was the highest part of the spike here, okay? The difference between the VIX and the nearest future got up to about 15 points, okay? The video I came out with on Monday talked about how, or maybe it was Tuesday, talked about how on the up move, or on Tuesday, on the up move in the market, we reduced that spread to about 7 points. So 7 points between spot and the futures. And that's a huge, that's halfway back to where we need to be. So that was great. Even though UVXY and VXX didn't go down that much, we got like halfway back to where we need to be. Yesterday, the markets ended lower after a little rally, and that's expected. We don't expect like a recovery to be straight up every day. We expect back and forth. However, as the VIX went higher yesterday, the futures were pulled up with it, and so we were able to maintain, even on a down day, the spread did not widen very much between the VIX and the futures. It widened by about a point, so we were up to like about 8 and change difference in the spread. Now, the spread between, or the difference between the price of the VIX and the front month future, many people call that the roll yield. So I'll refer to that as the roll yield from now on. So progress today would be, regardless of what the market does, up or down, sideways, would be for the roll yield to contract. Okay, currently I'm showing the VIX 32.93, the closest future 27.53. So that is a difference of $5. Excuse me, $5 and or a little under. So right around $5. Let's just call it $5 because it's been bouncing around all morning, a little bit lower, a little bit higher. So if we can get the spread down to $3 today, that would be a huge victory. And certainly when we have the VIX down 389 and the front month future down 162, you can see the VIX is down more than the futures, and thus we are making progress. Thank you for your math, Edward. Sometimes I'm slow on math, which people make fun of me for because I was very fast at some point. I must be getting old or something. But the spread, if we can see the spread narrow every day, then we're definitely making progress, because as the chart writes itself, we will go back into contango, and that will start to decay these products very rapidly. Right now, we're in backwardation. That meaning it's a kind of a fancy term, just meaning that the front month future is a higher price than the second month future. If we go back to our little chart here, we can see it's showing, if I center it right, that we have we're in backwardation by almost 11%, and that's a big deal over time, because that's 11% per month that these are being pulled upwards, like permanently. Their value versus the VIX is being pulled upwards, all things equal, permanently. And once again, we don't expect that situation to stay very long, but I've been saying that for a few days right now. Contango tab, sure. So this is just an illustration, and I'm just going to isolate the first 2 months This is just an illustration of when we were in contango and when we were in backwardation. And you can see, as I try to isolate where we are right now, you can see that we are below the red line right now. Anytime we're below the red line, that means we're in backwardation. So you can see most of the time we spend up here in contango, and they say between 80 and 85%. But now we're in backwardation, and it's not good for shorts. If we can't get this turn structure to right itself in the next week and a half, this stuff is going to move higher because we're going to come into expiration in the futures, and they are going to get pulled up. At least the front month is going to get pulled up towards the spot price. However, I'm pretty confident that that we are going to continue to see this spread contract. You know, $7 in one day, that's a pretty big move. 50% contracted. We've made another $2 over the last day or two. And I would expect to see $1.50, $2 today. If we do continue to rally day, maybe even more. So we are making progress every day. And, you know, I know a lot of people were kind of like disappointed on Monday that the UVXY and VXX and TVIX were not down more. However, the fact that we were able to tighten the difference in the roll yield by 50%, down 7 points, was huge progress to getting back on track. And all things being equal, this ship will right itself. It's like a one of those boats that has a big pontoon on the end of the mast, like one of those like catamarans. It's going to right itself. It wants to right itself. This stuff wants to go back to contango. It's just a matter of whether the market is so extreme that it lets it do that or not. Now, I want to show you for a second where we're getting the VIX from, because when you look and you see VIX 32 and the VIX futures 27, you think to yourself, why is it 32? Why doesn't it just go right back down? Normally this stuff goes right back down. Well, let's pull up a chart of the SPX here for a second, and we can see. All right, so this is SPX options. Now, SPX has a ton of different options series, so I'm just going to pick one that's like maybe this one that's 19 days out. And you can see, if you look at the right side of this chart, you can see it gives a like a one number volatility per expiration series here. And you can see these numbers. Gee, they look kind of like the VIX, don't they? So, and remember, the VIX is 30 days out. So if we were to go and look at a measure of the SPX that was like 30 days out, gee, it looks like 32, 31. That looks a whole lot like the VIX. Actually, that's what it is. The VIX comes from options in the SPX, and it's a measure of volatility 30 days out. So this is where this is all coming from. So to get the VIX to move lower, people need to come in and sell this stuff. If you look at some of these options here, for example, let's go to 30 days out. And this stuff looks, it looks expensive to me. You know, the 2600 strike, right now we're above 3,000. 2600 puts, $15 bid. And in normal times, people would come in and sell this to make money because it's been an easy way to make money for a long time. You come in and sell these puts, and the stuff always goes up, and you make money all the time. However, the people that were coming in and selling these every day lost all their money. Yeah, I just went through that account value. I'm not going to publish my account value because people are bugging me, but about that lately. You can watch the beginning part of the video. People are making fun of me, but I'm still in the 4,000s for this account, and then my other account where I've been buying the triple Qs has moved up quite a bit. So that's where you go. That's how it works. All right. So this is where we're getting the VIX from. And the other thing to notice about this chart is that there's a skew in the SPX chart, right? So as we move up strikes, if you look on the far left side of this, it's going to show implied volatility by option, right? So as you move up in strikes, you see that the volatility goes down. So in this way, as the market rallies, the VIX gets lower just by nature of the fact that we're moving up the skew. So if we were to go right now, we can see that at the money 30 days out it's showing here 36.82%. But if we were to move up to say 3,100 as at the money, it shows 31%. If we were to move up to 3,200, it shows 25%. So in this way, as we rally and we move up in the skew, the VIX kind of automatically moves lower, even if people aren't coming in and actively selling options in the SPX. So let's see. Oh, am I supposed to see a question here? I thought 60 days was enough. Probably not enough for UVXY. I don't know. So Mach 7 Radio says, I thought 60 days was enough. Probably not enough for UVXY to come in. I would think it would be enough for UVXY to come in. I would think that we would see significant sell-off next week, but I've been wrong in the past, and you know, it doesn't cost that much more to go out another month, right? So if we're looking at UVXY, for example, let's say that you had a trade on for April. Let's say you were buying the April 21-18 put spread, right? You buy the April 21 put and you sell the 18 put. You pay $1.38 for that. If just that gives you 44 days, right? Well, how much would it cost you to gain another few days, to go out to June, for example? Let's see. So April is $1.38. June is $1.85. So it's another 50 cents. So that is a significant amount, of course. But going out to June would give you, you know, it's over double the days, 100 days. If we look at like these March ones where it's just a week out, so let's look at March. So March 6th, the spread would be 36 cents. I wouldn't recommend doing that because that's just about to happen. But March 13th, $1.01. That's strange. March 20th is less. I think it's just because we're getting weird marks on that. March 20, March 27. Yeah, we're getting weird marks on this stuff. I doubt that this could be traded at the midpoint like that. So that's a little bit strange the way it's doing it that way. But my point being that always give yourself a little more time than you think, because so many times I've gotten burnt thinking, oh, well, 2 weeks is plenty of time for this stuff to settle out. And then it ends up happening in 3 weeks instead of 2, and I'm off by 1 week, and so I just get crushed. So give yourself more time. Like I said, you know, you're giving up a little bit of return, but if you roll out to June or July, and I've been trading VXX right now, if you roll out to June or July in VXX, you can put this on and you don't have to worry every day and watch this stuff every day and be like living and dying by each tick in the SPX. You can put it on, leave it, and it's almost guaranteed that in 3 months from now this thing is going to be over. It's probably going to be at least partially over in the next week. We've seen stuff come in a lot already. Currently, it looks like our spread has narrowed by 2 points so far today. So, if it narrows 1 point tomorrow, 1 point the next session, then we could be back at least flat by the end of the week as far as the term structure goes. So, I would. It makes a lot of sense just to put something on farther out in time and then just leave it. That way you don't have to worry as much about timing it right, because we know over time this stuff's going to go down. We don't know exactly when it's going to go down. So, I've been wrong a couple times already by trying to pick the top or trying to get cutesy with dealing with too close to expiration type stuff. And so I would recommend just moving your stuff out a little further. You know, if you're going to go with April, if you're fixed on going with April, I would move out to May. And a lot of people who have been doing this for a while, their returns started getting better when they stopped being as aggressive. When they, you know, instead of picking the 2017 put spread, they picked the 2118 put spread. Because in the end, we want you to be profitable, right? It doesn't. The home run is not what we need. We need, you know, a little money coming in all the time would be better than home run and then blow up, home run and then blow up. So there you have it. Kind of, it's encouraging today, but once again, we are higher in VXX than we were a couple days ago. However, we are in better shape in that the term structure is closer to righting itself. Just think of it as if we could get the back months all the way up to 30. So if the term structure right now was VIX 32, front month 35, second month 38, we would be back in a decay situation even. So as this, I would measure progress based on how this spread is contracting and how this term structure is getting back to normal, because that in the end is what's going to make us money long term in this product. And I've stopped trying to pick whether this is going to happen today, tomorrow, or the next day. I've moved my stuff back out in time. I kind of screwed up by trying to do this front week stuff because I got burned. It didn't happen right away, and we actually moved higher. And so what I learned was to move my expiration out a little bit in time. Let's see. Chance of a spike. Yeah, I mean, we still, it's not inconceivable that this market could roll over again, right? And we could take out the lows of before. It's certainly possible. Nobody really knows what's going to happen. Only thing that I know for sure is that the VIX is at a high area historically right now. And if I put a position on that's far enough out in time, it will work. Beyond that, there's no guarantees today, tomorrow, the next day of what's going to happen. We don't know. We have to use what we do have as an advantage with this particular trading setup. And that is, over time, we know the stuff's going to move lower. Somebody who's trading Apple, they don't know for sure over time whether it's going to go up or down. But we know for sure over time, UVXY and VXX will take out the lows and will reverse split. Ed says, since the VIX can stay low for long periods, would it make sense to only sell vol when we're in contango and get out once we get in backwardation? Many people do believe that, Ed. The thing for me is that by the time we get back in contango, we will have missed a big move down. So for me, I'd rather put a position on here that's a little farther out, knowing in my mind that we will be back in contango. But yes, many people do take that strategy of not playing this until specific criteria are met. And, my buddy Brent is more of an expert on that sort of thing than I am. For me, I want to put a position on here when we're in the middle of a spike and ride it all the way down. And then once we get way in contango, and we're hitting the lows again, then I tend to actually start to take my positions off. The efficient market hypothesis. I like the long tail in these short vol trades. Man, I got lucky last summer on long vol. Yeah, now, by Raymond Gecko, and I hope I'm pronouncing your name right, by efficient market hypothesis, you mean that the options market is pricing stuff efficiently? Because we found out 2 weeks ago that the market was pricing stuff way too cheap on that big move down. So I believe that the market tries to price stuff efficiently, but finding where it's not doing that correctly is one of the biggest ways to make money trading. So there you go on that. yeah, getting, everybody has the dream of buying UVXY right before a spike or buying some calls right before a spike. But in practice, a lot of times you're just going to burn through all your capital holding on to calls. A lot of stress could be avoided only selling vol warrant. Yeah. Seems a lot of stress could be avoided by only selling vol warrant in contango. That's true. I guess it really depends on your risk tolerance and what you're willing to put up with. I was taught that we're in the business of taking risk, and we are rewarded for that. And yes, I suppose some people will wait until we're back in contango and then go from there. I've had some good success just kind of buying the dip and selling stuff back out. I've been trading the TQQQs a little bit, and just when we make that down move, I've been buying a little, and then when we go back up, selling it a little bit back out on the side when not playing with the VIX. The VIX really is a proxy for being long the market. So when you're short the VIX, you're really long the market, and that's the way it is. Now, yes, there's a lot of people who are like to short the market and are bearish on the market, and most of the time it doesn't work out. Now, when it does work out, people make a lot of money, but most of the time it doesn't work out. All right, so I am going to let you go now back to your normal lives. Thank you for watching. I hope it sheds a little bit of light. Remember, just keep track in your mind of the distance between the VIX and the first future, and we should see that decay until it's down to 0 and the VIX is below the futures as the coming days occur. As the volatility kind of comes in here, people had a lot of tolerance for like this huge wide range, and so far today we've seen the range narrow a little bit. It's been pretty wide though, several days in a row. We'll see if the range narrows as far as these products whipping around. It was pretty whippy again yesterday. Thanks for watching, and I will see you next time. Thank you, Edward, for your moderation of everything, and thank you everybody else for tuning in once again to the Short Vol Show Live. I hope to see you again shortly. Bye now.